Rich, it's great to have you. Let's start with software. If you're looking at the IGV, what is it telling you right now?
Yeah, thank you so much for having me, Carl. Well, it's telling me what much of tech and markets more broadly are telling us, that after a very promising rally high lows, we've fallen back into that pattern, certainly exacerbated by the Jackson Hole comments. But what we see now is an ETF, if you will, and a sector ETF that's struggling to hold on to support here around that 50-day moving average. But our contention is, Carl, that software will find its footing, and that breakout that you saw in July, that surge, was really sort of a preview into the future of what we will expect this fall. And I don't view the recent weakness post-Jackson Hole and going into the event as sort of a prelude to a bigger retest of the lows.
Do you think, is that view getting ratified by the SOX or the Qs or ARK or crypto or anything else?
You could keep going, Carl, and just keep naming stocks and sectors, because we do see a lot of technical symmetry out there, unfortunately, for the bulls. Again, it's that classic setup where we know we've had that bear market decline 30 to 70%, depending upon where we look. But then again, June, July, you get that big surge, that textbook reversal off of long-term support from deeply oversold conditions. Our view is that this is a retest of that surge, and that we have made the turn. The bottoms are in, but as always, the bottom is a function of time, price, and in this case, volatility, Carl.
But Rich, we're about to get a lot of information, aren't we? Because the holiday season doesn't start with Black Friday anymore. It starts sometime in October, and there are all kinds of questions, yes, about inventory, also about consumer demand, about how much of this is going to come from e-commerce. We'll be looking at data, including Adobe's and others, about what they expect for the season. Won't that have a big impact on how software fares?
Yeah, no question about it. But I think what we're starting to see in the charts is that price tends to discount the fundamentals that are to come. And I think across the board, I don't want to say every stock, but in many cases, the stocks that matter, you're starting to see the constructive signs in the technicals that would suggest that the fundamentals coming down the road will arc in the right direction. And I think you can see that by virtue of some of these breaks of those well-defined downtrends that had defined the bear market. Some of these very constructive bases in stocks like Intuit. You take the recent surge in a huge consumer stock like Amazon, a huge consumer stock, the hugest consumer stock in Amazon. It had done something it only did one other time, going back to the depths of the financial crisis, but yet it's not the financial crisis, which tells me you want to be a buyer of Amazon and that the consumer can do just fine.
Rich, what about Chinese tech? The KWEB ETF, one of the only ones that is up today, and Pinduoduo shares, they are surging. Maybe this thought that perhaps it had bottomed out. What are the charts telling you, especially about risk appetite?
Yeah, I like where you're going with that one. Look, we know China is a market that beats to its own drum, and in this case, it had led us lower, like much of the longer duration, more speculative assets, peaking in January, February of last year, as Mike Santoli alluded to. But again, challenging the 32 level on the PGJ, that's the Golden Dragon Internet ETF, led by stocks like Pinduoduo, also Alibaba getting back on its high horse, trying to challenge that 200-day. I think better days are ahead for China Internet and China more broadly, which should have positive read-through for risk appetite more broadly.